Get more on European stocks and bring in William Nabbaro, head of European equities at Exane BNP Paribas, and he joins us this morning from Singapore. Bonjour, William. So let's ask you first. Do you agree with Citigroup's estimates for European stocks? Do you see more gains this year?
This year maybe not, but effectively next year we'll not be surprised if we're going to see more gains effectively coming through. Everything it depends, of course, a little bit also how far or how good, say, Q3 and Q4 are gonna be. For the time being, we remain still very, very hesitant. But effectively, we have seen the stimulus packages doing very well, not only, of course, in China, but also in the US. And that will, of course, filter through also to the economy. But for the time being, we prefer to remain still a little bit cautious. So that's also why you see that most of the picks we are having remain still in the defensive side, although you can hedge, of course, with some of the more high beta stocks as well.
Yeah, well, I mean, let me just pick up on your outlook that you don't think we'll see more gains for European stocks this year. What do you think will hold back European stock markets for the rest of this year?
Effectively, well, if you look at the real economy, well, it is still not where it should be. So it is growing, but it's growing very lightly. If you look at the latest figures also from the OECD, they were not the best in the world, or the predictions were not the best as well. However, effectively, we see that European companies are coping with it, and they're coping maybe better than some of the other companies in other areas of the world. And that's also why we say, effectively, and I'm not surprised effectively the European markets have been underperforming, say, the Asian markets. But going forward, it is probably a good idea, effectively, to start pouring some money into the European markets as well.
Okay, well, if you do pour into European markets, you're advising going defensive, and one of your picks is Novartis, which is Europe's second biggest drug maker. Though its shares have lagged its peers, such as AstraZeneca, so far this year, and it's trading at a slight discount to its peers in terms of price to earnings and also book value as well. So why do you think this is an attractive stock to buy into?
Well, effectively, it has been underperforming the sector, and it has been underperforming the rest of if you look at AstraZeneca. You can also compare it, for example, with Glaxo. It is effectively, it's not underperforming slightly, it's underperforming tremendously. It is 20% below the sector. So that's also what we're saying. Effectively, Novartis is probably one of the better picks for the second half of this year, going forward into the first half of next year as well. News flow is going to be very, very light, so no unpleasant surprises coming through from that end. We know effectively what is coming off patent in 2013. It's very well known. Everybody knows about this as well. And we had a lot of stories also about the integration with Alcon that might not be the best thing for Novartis. We do not agree with that. We think it's effectively a very good opportunity. It will give a lot of cost reductions for Novartis as well. Synergies will come through, will kick in. So that's also what we're saying. Novartis is probably a very good pick for the second half of this year, going forward into 2010. At this kind of level,
William,
we don't expect. Yep.
Yeah, William, you want to put a number to your optimism on Novartis because the analysts in our Bloomberg survey are pretty bullish on the stock. They're seeing an upside of maybe 17%. What are your predictions?
Yeah, well, we're looking also at some very good upside. We're looking at 55 Swiss francs, so you've got very good upside from here.
Okay, well, Novartis, what about Novartis's potential development of a swine flu vaccine? It's being considered for human trials. Do you think that could be a good potential and also lucrative for this stock as well?
Well, anything to do at this moment of stage, it will be with any of the pharmaceutical companies, anything to do with vaccines on swine flu, or with any virus which come through in the next coming months or years, because every time something new pops up, will of course bring some news to the companies who are developing that, who are producing that, and that may help them to go higher as well. Effectively, that may trigger them.
Okay, William, let's quickly squeeze in a question about Total, because you like Europe's largest oil refiner, and it seems like a stock that analysts like as well. But isn't Total, isn't it facing these squeezing margins as we speak?
Well, Total has got a very good point, because they're sitting on marketing margins which are much higher than the rest of the sector. Also, if you look effectively the cost base for Total, they are much lower as well than the rest of the sector. If we also look at the development of Total, look at Total, you will see that in oil sands, they are hardly present. Now, there are other companies who are much more present in oil sands, and the development costs for oil sands are very, very high. At this moment, we're looking at something like $80 a barrel. Look at where the oil price is. We're looking now at, what is it, $71, $72 a barrel, so they're losing $8 a barrel already at this moment in order to produce a barrel of oil. The technical cost for Total are around $12.50. Total itself, they are looking at around $40 a barrel. So those guys are in the right spot.
Okay, William, we have to take a break, and after this break here on The Edge, oil, as we've been saying, is likely to head higher again after a plunge in supplies. We'll get details after this. Send us your questions at the email address that you see on your screen. We'll see you after this commercial break. Okay, welcome back to the Bloomberg Edge. Let's continue our discussion with William Nabbaro of Exane BNP. And we're talking about European stocks. And William, going into break there, we were talking about Total, which is Europe's biggest refiner. Now, you say margins are not a concern. What about the location of the oil supplies? They do work in Africa, and we did have that attack on a Nigerian oil field recently.
Exactly. Well, that's the problem for not only Total, or it is a problem for, of course, most of the oil companies which are located in some of the hotspots around the world. Effectively, Nigeria, well, we have seen that not only, well, this is not the first time that this is happening, it's happened in the past as well. If you look at the portfolio of Total, of course, they are in Africa. Everybody knows that. But they're not only in Africa, they're also around the rest of the world as well. And effectively, if you get an attack on say, one of the oil companies or the refining fields, of course, that will directly trigger some panic. But overall panic, it won't change the rest of the structure of the company.
Okay. William, and ask overall upside for Total. What do you see?
We're looking at 50 euros a share at this moment of stage. Depends, of course, also what's going to happen to the oil prices. For the moment, we are looking at around $50 a barrel for the second half of this year. So effectively, it might tweak a little bit lower. If the oil prices continue rising and continue to remain, say, between $75, $80 a barrel, of course, the upside is going to be a little bit higher at that moment of stage.
Wow, $50 a barrel. Okay, William, stick around. Let's check in now on oil prices and bring in Nabbaro Roy, our reporter in Mumbai. And Nabbaro, you heard William Nabbaro there predicting a $50 oil for the second half, but we're nowhere close to those levels right now. In fact, what's pushing crude prices higher to the highest of the year nearly?
Morning, Susan. Well, inventories in U.S., the largest consumer, has fallen, and that is also pushing prices up today. The government is expected to release data today, the U.S. government, and that should give a clearer direction to the oil prices. Oil prices have gone up 41% in the past quarter. One of the reasons being, of course, the weaker dollar. People are investing in commodities, including oil, and also attacks in Nigerian fields.
Okay. And what about the next moves for crude oil? Because we're seeing technical analysts saying that it could actually rise after it averted a slide.
Yes, absolutely. And some analysts are in fact saying that it should rise to 76. It will, it's crossed the psychological 70 mark, and it's hovering around between 70 and 73. So that is a good reason. In fact, it's attracting consumers like a magnet. That is what some of the analysts are saying. Of course, it had fallen yesterday below 70 when the U.S. consumer index fell. But again, it's gone up because there are reasons that is keeping oil above 70.
Okay, Nabbaro, thank you for that. Nabbaro Roy in Mumbai. Let's stay on the commodities theme. And we got an email from a viewer who asked, do you see a correlation between the upward move in oil impacting coal futures. Well, Sibik, one of our recent guests, ANZ commodity strategist Mark Pervan, says that coal prices, especially seaborne coal from Australia, may see support as oil prices continue to rise. And the reason for that is that an oil price increase suggests that a broad recovery in the economy is underway, which may stoke demand for power from steel mills to utilities. So coal may also benefit as an alternative to oil if prices of the latter continues to climb. Now let's bring back in William Nabbaro, who is the strategist at Exane BNP. And William, let's talk about ST Microelectronics. This is Europe's biggest chip maker, but it's not doing so well these days. If you look at its second quarter revenue, which dropped as much as 27% because people aren't buying consumer electronics anymore, and therefore demand for chips is falling. What do you see for ST Microelectronics for this year?
Well, we have seen effectively that the sector has been performing very, very well. That's also why we say, well, ST Microelectronics is maybe not a good idea to buy it at this kind of levels. However, if effectively ST Microelectronics, the share price drops a little bit, say to around €5 a share, it becomes very, very interesting again. We see effectively also the valuation of ST Microelectronics is one of the cheapest you can find in that sector as well. And at the same time, we're also looking effectively at the restructuring story at ST Microelectronics, which is a continuous story, and that's also why we're saying it is probably a very, very good idea to look at this company. But again, start looking at it around €5 a share. We know effectively that they have exposure to automotive. We know that, of course, there is news about what the exposure they have with Nokia. They're supposed to be a first client they have. The stories which came through when Nokia was supposed to sign with Intel, and everybody was, of course, very, very much afraid that they would lose the #1 position and some of the margins effectively because Nokia would be using Intel. We do not see that Intel is going to go into the handphone business, so it will probably be some kind of other device Nokia is going to come out with.
Okay, William, we have time for one more of your stock picks. The final pick is Smith & Nephew. Hopefully I'm saying that correctly. It's Europe's biggest maker of shoulder and knee plants. Unfortunately, though, its biggest market is the U.S., and of course we know what problems the U.S. economy is going through.
No, that's true. But on the other hand, also look what is coming out of the Obama government. We see effectively that the Obama government is going to invest in research and development, and effectively that's very, very good for Smith & Nephew. We have seen that patients and effectively have been pushing away and pushing off operations because they are very, very expensive operations. If we look at knee replacements, effectively shoulder replacements. However, this will not go on indefinitely, so people will come at every moment of stage also. Other point as well, there is a study which came out which showed effectively that knee replacements, especially for, well, not only for Smith & Nephew, but from other players as well, are cost effective. And of course, this is very, very good news, especially for the American market, which is the biggest market, like you mentioned yourself. If you look also at Smith & Nephew, it's the cheapest you can find in the sector.
Here, so yeah, let me just ask you quickly, 20 seconds here. What's the upside on the stock? What level should you get in?
Okay, so you can get in now, but it's a long-term investment. Don't expect it's going to go up in the next week or so. 675 is the target price, so you've got massive upside potential on this one, but it's a long-term investment. This is a really one for the long-term investors.
Okay, Williams, great talking to you. William Nabbaro of Exane BNP.